Welcome to The Riff, where writer and investor Bern Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
I do want to start every week's episode with the juiciest but most appropriate thing I can think of, and today it's Yann Lecun and Elon Musk's rivalry and subsequent bromance. I know you didn't write anything necessarily about it, but is there any quick commentary worth getting into of what's happening there, or no worries if not?
It's the kind of thing that I sort of tune out. Just like, I don't know, pissing contests between successful people on exactly what is the right rubric for measuring success is like, I guess it's kind of interesting from a human standpoint, but less interesting from a standpoint of understanding broader trends in the world. I mean, maybe what it tells you is like there is actually no amount of success and no amount of career achievement in your field that will make you feel completely satisfied that you are actually accomplished and made the right calls. Like, it's entirely possible that it is like this desire on both their parts to switch sides, where one of them wants to have had a huge impact on, a huge impact as an academic on some really important field. And then the other one is like, well, I can't believe I don't have $200 billion. Like, I'm smarter than this guy. What's going on here? And so I saw some of the interactions and just kind of zipped right by as like these people are both kind of embarrassing themselves. But it was nice to see the little congratulatory remark after the fact. So I guess I don't know if that's deeply heartfelt. I don't know if that's apologetic. I don't know if that was sarcastic. I would like to think that they both decided they have better things to do with their time than litigate the true definition of science and figure out which of them is actually the most impressive. They both seem pretty impressive to me.
It does seem like there's this meta debate that we've been having over the last few years, especially with COVID, as to we have this technocracy or whatever, this small group of people that make decisions that influence a large group of people, and people notice this sort of phenomenon. And then the question is the problem that they're just making bad decisions, you just see new people, or is the problem that the structure of a small amount of people or a small amount of institutions making decisions for everybody should be changed in some fundamental way? And it seems like both of those camps are conflated as to just being angry at the current set of people making the decisions.
Yeah, like I'm generally sympathetic to the idea that many elite institutions select for the wrong things and do so repeatedly, and that you end up with worse and worse people as you get higher up in the hierarchy. But I don't know how much of that is just intrinsic to institutions in general, that they start out really good and really effective, and at some point there's just more leverage in being good at manipulating the perception within that organization versus manipulating the outside world in some way that corresponds with that organization's mission. Like, that just seems like an inevitable factor for any group of people larger than one. Like, you have one person, you have no real corporate politics, and then once you've scaled to two people, now you have some real world activity, some signaling games, and that just rises factorially as you increase the number of people. So I don't know what the right solution to that is. Like, you could imagine some kind of idea where you basically give every institution, like, I guess you could think of it the way that charitable foundations operate, where they generally have to spend 5% of their wealth every year. And what that means is that if you are a well-run foundation, you can just grow forever and you accomplish a little bit more of your mission each year. And if you aren't really on the ball, then you eventually just dwindle into nothingness. And so it's kind of fun to speculate on how that would look for other institutions. Like, if the FDA had some kind of clock ticking where it's like, if American lifespan and health span isn't increasing by X% per year, your budget gets cut. And, we lower our standards a little bit as the budget gets cut, but like, you need to be doing something better every year to justify your continued existence. Maybe that gives them a little bit more energy. Maybe you could imagine something like that in education, where you wouldn't go to zero-based budgeting, but like maybe the default budget. There's like some default budget cut, and then you have to justify every budget increase. But when you try to set up rules like that, you have just created a new avenue for gaming things within an institution. Like, I'm sure that if there was some rule like like education spending in the US goes down by 5% per year by default and only goes up if test scores go up, well, suddenly there's going to be a lot of effort put into designing easier tests. And so then you need someone who audits those tests. But does that institution eventually get captured? And do you have some way to measure their output? Like, at some point, you run into some fundamental limits around just human trust and the ability to organize large groups of people to accomplish some specific task without eventually losing their way. It does seem to happen to every organization. It seems like the best you can get is, if you're conscious of its inevitability, you can delay it for a long time. But I think it's like, maybe aging is a good analogy there, where if you're really, really health conscious, then, and you're also lucky, you can keep yourself reasonably healthy for a long time. There was a really good article about Ed Thorpe, the hedge fund manager, who is in incredibly good health for someone of his age. Like, I first noticed this when his book, A Man for All Markets, came out a couple years ago, because there was a photo of the author on the book jacket. And I thought that it was just a 20-year-old photo, because he was, I think, in his 80s when that book came out. And he doesn't look, young, but he looks like he's a healthy guy in his early 60s. And it turns out he's been just obsessed with exercise for a really long time. And so, he's still in really, really good shape for someone of his age, but it's like, I think he can do like 25 push-ups or something, which is like insane for a 90-year-old, but also much, much worse than it otherwise would have been. And, does not take very much time for a 20-year-old to train to the point where they can really outperform that. So, like, if you know that your time is finite and that decay is the default, you can delay that for a really long time, but it does eventually happen. And so you sort of have to embrace the idea that you will at some point peak, you individually or your organization, at some point it will peak, and it will never be able to be as efficient and effective as it was at that peak point. You won't really recognize that point until it's long past, but you can struggle valiantly against that for a long time. And there's a lot of value in that struggle. There's just a lot of value in constantly asking yourself, what are the problems that I can address today that will be extremely severe problems in 5 years? And, what can I do to make sure that those problems don't go away forever, but maybe they're problems 10 years from now, 20 years from now, and not they don't come any sooner than they have to.
Yeah, no, that's well said. You mentioned captured. I want to transition to activists of a different kind. Talk about the Elliott and TI. What you found so interesting about that?
Yeah, the good kind of activists, the people who buy a lot of stock in a company, file a 13D, and tell them to cut costs, i.e. fire people. Now, that's like it. So when I read about that, I started with just thinking about, okay, what is the social utility of shareholder activists? Like, and also, what is the source of their alpha? So for anyone who has an investment approach that generates better returns than you would like, better risk-adjusted returns than are available from just generically allocating your money to asset classes, like, there has to be someone on the other side of that transaction who's doing something irrational and giving you a good deal. And what I think happens at a lot of companies is that there's selection on the CEOs for a lot of good traits. Like, you want a CEO who understands the business, is reasonably charismatic, can do enough math to make sure that the company doesn't run out of money, et cetera. Like, you want that kind of selection, and you want the people who get the CEO spot to be really good. But another thing you're selecting for is people who really, really like the company, people who after a while have made most of the key hiring and promotion decisions. So they have decided who is reporting to them and who they're surrounded with. And they've also chosen a lot of the company's strategic priorities. And everyone is just irrationally attached to decisions that they've made in the past. It's really hard not to be, and it's probably useful to be, because a lot of those decisions, it takes a long time to pivot from them. So if you are at a hedge fund, it can be great to have just ruthless stop loss discipline of, you put on a trade, it went down 2%, you're out. You're not thinking about that trade again because you were clearly wrong. But if you are coming up with your 5-year plan for capital expenditures at your semiconductor company, and you start building a fab, the fab is halfway built, you spent $2.5 billion on it, and suddenly the value of that fab is 2% less than you thought it would be, and you're just like, okay, that's a sunk cost, we're out of here. That's probably not an especially healthy attitude. So a lot of CEOs of companies will just tend to be a little bit more committed to both their strategy and their team than someone who was coming in with a clean slate would be. And so activists, part of their job is identify cases where the CEO really should have changed plans a while ago, or the company should have changed CEOs a while ago, and then buy enough stock and make enough noise to actually make it happen. But the TI case, it was I found it kind of dubious. So the Elliott's argument, which is true, is that Texas Instruments among the analog semiconductor peers, like it is spending much more on capital expenditures than any of those other companies. They are building a ton of capacity, and if you look at consensus revenue estimates for that line of business, they're building more capacity than they actually need by a pretty significant margin. So Elliott's asking them to not do that, but companies tend to not make those kinds of decisions totally arbitrarily. I think there was like a brief period in maybe 2021 where you could say that CapEx is the new buyback. Like Intel, I think their stock popped one time because they said, we're actually going to return less capital to shareholders, we're going to spend more money on fabs. And so there was this vogue for a while of just, you should actually reinvest in your business. It is a good idea. Corporate America has been chronically reluctant to expend much capital. So, we should fix that. Which, by the way, that is hard to square with the claim that CEOs like to empire build and are irrationally attached to their spending and growth decisions. But we'll table that for a moment. So, like there was this period where, that was a really popular move, and now maybe investors are just a little bit less excited about endless growth stories and endless spending stories, and more excited about buybacks again. So, Elliott wants Texas Instruments to dial that back, but when I looked at, they have these various comparison tables listing the semiconductor companies they think are similar to Texas Instruments, and they talk in their piece about how they talk in their open letter to the company about how Texas Instruments has always said they're trying to maximize free cash flow per share. Now they do play a little bit of a rhetorical trick here, because they cite I think it was like 5 separate excerpts from 5 different investor conference calls where the CEO of Texas Instruments over a half-decade period is constantly saying that is our key metric, is free cash flow per share. But in 4 of the 5, the specific way they describe that key metric is long-term free cash flow per share. And if you think that if you think that the world actually does not have enough semiconductor capacity and that the particular chips that you make will be in high demand in the future, then the way you maximize free cash flow per share in the long term is you reduce it in the short term by spending more of that cash flow on investing in your business. So I thought that was a little bit tricky of them. But the other thing that occurred to me was just, if you think that that's the wrong strategy for a company in that space to choose, well, you've listed all of these comparable companies. You could just buy one of them. You could buy all of them. You could buy every one of those stocks. You could short a bunch of Texas Instruments, and you could say, okay, we are betting on the companies that are making the correct strategic decision. We're shorting the company that's making the incorrect strategic decision. One thing that juices our returns is TI is going to build too many fabs. They will end up not being able to sell all the chips those fabs make, or not getting enough orders to run those fabs at full capacity. They will probably change their mind, change their management team, sell off some of those assets, and somebody else will buy them at pennies on the dollar. And they do mention that TI has been able to do this when other competitors have spent too much. So it seemed to me that just on an object level basis, the trade that made a lot of sense long term, that doesn't require any activism, is just if one company is making a strategic decision in a space and you think it's the wrong one, you just bet on their competitors. And if you're making a relative value bet, then it's okay if there is a glut in that part of the chips business, because the company that has the least liquidity is the one that's hit hardest by the glut. But I thought the other, and what I suspect is that if TI said, okay, we are dialing back our capital expenditure plans, we'll still be spending more than most of our competitors, but not quite as much as we intended. Instead, we'll be buying back stock. The stock would pop. But what investors are left with then is they actually don't have a choice. If they are really optimistic on a CapEx heavy strategy, they no longer have a way to express that. So it actually would make the industry as a whole potentially worth less if you just have fewer ways for investors to express a view. And what I think that part of what that highlights is that the risk, like the social risk of shareholder activism, is that it bullies companies out of nonconformity, and that sometimes the obvious strategic choice is the right one. Sometimes a company is making a risky bet that may or may not pay off. They may or may not have handicapped the odds correctly. But if every company is running the same strategy, then the entire industry is at risk that strategy is the wrong strategy. And what potentially happens in that case is, yes, there is someone who decides to spend a lot of capital on chip fabs, and his name is Xi Jinping. And eventually, if you need those particular kinds of chips, you're importing them from China and not buying them from American companies. So I do think that is a risk that is, it's not the shareholder activist business. Like, it is just, a hedge fund is not in the business of optimizing the global economy in order to avoid supply chain risk and in order to, better improve the US's position in geopolitical contests. That's just not what they are paid to do. And we probably don't want our foreign policy run by hedge fund people entirely. I'm sure getting their input would be helpful, but having them run the show is probably not optimal for anybody except them. So it's not really their business, but that is just a reason to be somewhat skeptical of that particular plan.
Yeah,
but like they've done a lot of really effective things in the past, and they have an amazing track record as investors. So you should, if you get the angry letter from Elliot, then the first thing you should do is a lot of soul searching on what you think that they don't know, and whether you are a better investment analyst than their team is. And it's there's like, certainly the CEO of Texas Instruments knows more about Texas Instruments than a researcher at a hedge fund. On the other hand, that researcher probably does have a broader perspective on the relative strengths and weaknesses of these different companies, particularly on the financial side. So, it's good to get that input, but it's not the end of the story.
Yeah, fascinating.
We'll get back to the conversation in a moment after a word from our sponsors. Fast forward to the end of 2024. Think about your goals. What can you do right now to give yourself the best chance of succeeding? If learning a new language is on your list, you absolutely need to check out Babbel. Babbel offers a range of learning tools, self-study app lessons, live classes, and even podcasts, which have always been my favorite way to learn. Studies from Yale, Michigan State University, and others continue to prove Babbel is better. One study found that using Babbel for 15 hours is equivalent to a full semester at college. Babbel isn't just a game to kill time and make you feel like you're learning a language. It's not overly academic or rigid either. It's all about learning language for the real world. Babbel stands out because it's designed by real people using a modern conversational teaching approach. It's not always easy, nothing worth doing ever is, but it's straightforward and designed to help you start speaking in just 3 weeks. With Babbel, I was able to brush up on my intermediate Spanish to ramp up for travel to Argentina last year, and was able to set clear goals based on how much time each week I wanted to practice. Join millions of Babbel language learners across all age groups. Here's a special limited time offer for our listeners. Right now, get up to 60% off your Babbel subscription, but only for our listeners at babbel.com/econ102. Get up to 60% off at babbel.com/econ102, spelled BABBEL.com/econ102. Rules and restrictions may apply. If you don't already subscribe to Turpentine's industry-leading newsletters, like our new daily AI newsletter, Emergent Behavior, or Media Empires, you should. But that's not what I'm here to tell you about. The platform we use to power these newsletters is called beehiiv, and it's excellent. First of all, it was started by the same early team who helped build Morning Brew into a $75 million newsletter business. And they built beehiiv to offer that same powerful functionality to anyone sending emails. From essayists to business owners, the platform is beautiful, their text editor is intuitive, and they help you scale your audience with custom growth features. beehiiv has powerful tools to help you monetize your content. You can easily launch paid subscriptions or pursue an advertising model. The beehiiv platform will even connect you to premium brands to sponsor your newsletter. Not only do we use them, but thousands of the top newsletters in the world also use them, like Milk Road, Blockworks, the Lindy newsletter, and so many more. beehiiv's founder hooked up Moment of Zen listeners with a sweet deal. Get 20% off for 3 months with code MOZ. Visit beehiiv.com, that's BEEHIIV.com, to get started.
You also wrote about the fake takeover offer for Getty.
Yeah,
they made. So why don't you unpack that?
Yeah, so this was today's issue, this morning's issue. It's Monday, by the way. This one was it was one of the clumsier white collar frauds that I've seen, where there was a guy who had been he'd been an executive at public companies before, so he knew the rules, he knew what he was supposed to do. He had I think tens of millions in capital, and he bought shares of Getty, the stock photo company, and started just spamming press releases and LinkedIn posts saying this company's undervalued, they should be sold, I think they're going to be sold, I think someone's going to buy them, and also they should be growing faster, etc. And then he put out a press release saying that he was making an offer to buy the entire company for a premium of, it was almost double the price at which the stock was trading. And then when the stock opened, he sold all his shares, and then he lied about having sold the shares. He also told a friend to buy stock in Getty and told this friend not to sell it until Monday morning, where Monday morning was the day that the press release came out. So very, very much, I think it was like an extensively documented fraud. Like every time he had an opportunity to tell someone, yes, I'm up to something shady, he did. For example, he was complaining to his broker that they were only letting him trade 200 options contracts at a time, and he said he needed a higher options contract limit because he planned on doing a lot of options trading in the very near future. They told him about some tax rules that would trigger if he sold all of his Getty stock and options and for a loss and then bought it back, that the IRS doesn't let you take a tax deduction on that loss if you do it too quickly. And he assured them he had no intention of buying back any of his Getty shares after selling them. So like he told a bunch of people in ways that the government was able to later recover that he absolutely intended to pump the stock up and sell all of his shares. What was really striking about all this was that his press releases had a lot of typos, and it reminded me of, like, in finance there is this kind of, in investment banking in particular, there is this annoying phenomenon where the people who are running things, they will send these incredibly cryptic, typo-riddled emails and text messages and things, and you just have to puzzle out what they meant. But if you, the first-year analyst putting together a presentation, if something's off by a couple of pixels, or you misspell a word, or you make a grammatical mistake, they just rip you apart. And people sometimes wonder, why does this system work that way? But it turns out that obsessive attention to superficial detail is proof of work, that it is, it's kind of pointless to spend 0 time on your financial model and hours crafting this beautiful PowerPoint presentation that has no substance whatsoever. But the substance is a lot harder to double check. So if you have this PowerPoint and you have, a list of comparable companies, very few people are going to try to reverse engineer what process you used to create those comparable companies. And did you strategically include or exclude someone who was kind of on the edge of mattering in order to make the case you wanted to make? Like, they're not going to do all of that. They're not going to double check all the work you've done, but they will notice if you misspell a word on the first page, or if you put the wrong client's logo on the presentation to that client, which is like the thing that a lot of people have war stories of doing. It's usually they realize that when they have printed up a bunch of beautiful copies of a presentation and it's the wrong company on the cover. So, that I think obsessing over those details, like, it is not going to guarantee that the substance of the analysis is right, but it's a pretty strong sign that that there's some sloppiness at work somewhere in the process, and it's just very unlikely that someone would get the superficial stuff wrong but actually have the substance absolutely right. So when this fake announcement came out, I think the day before, Getty stock was trading at about 5. The announcement said that we're going to buy them for 10. The stock went briefly up to 8, but ended up trading to about 650 after a while, by the end of that day. So, and that's, 30% increase is just not a lot for a company that has just gotten a serious, credible offer to be bought out at double its previous price. So a lot of people looked at the press release and looked at the other press releases and looked at all the caveats and things and said, okay, this is just not legitimate. And if they shorted it at 650 after this announcement came out, then they made money. I think it's under 4 right now, and the guy who engineered that is probably going to jail. So happy ending for everybody. The system works like that. So I think this ties into just in general. Markets do get manipulated. Like, people try to manipulate markets. It's really hard to do, but people do it. And sometimes they get away with it. But often manipulative behavior, it puts you on the wrong side of a trade. Like, if you are trying to artificially push a stock price up, that does typically entail buying the stock or making some public promise that you're going to buy the whole company. And then you either have bought the stock at too high a price and you're praying that you can sell it at an even higher price, or you have put out a press release that is materially misleading and gotten enough attention from regulators that they look into what you said and what you did and realize that you were lying and you knew it the whole time. So it's not perfectly self-correcting. Like, this is not a case where the market just reacted flawlessly from the beginning and didn't move at all on that announcement. But it was kind of close. Like, the market reacted as if this was of dubious quality, and then eventually decided that this was just not credible, and it kind of quietly faded away. And one of the, I guess, meta points, or one of the little footnotes here, is that not in this case, but in some cases, fake takeover offers can actually increase the fair market value for a stock price. And the mechanism for that is that if you have a company that is owned by just a normal shareholder base and the company is suddenly in play, suddenly someone says they're going to buy it, a lot of the shareholders who own it realize they can't really underwrite the odds of that transaction actually closing, so they want to sell it to someone who specializes in that. So the shareholder base turns over. Instead of long-term fundamental holders or random traders or whatever, you have more holders who are arbitrageurs. They are all aiming for get this company sold quickly, so they will vote in favor of a deal. They will push management to accept a deal. They will just kind of hustle to try to make that happen. So if there is a company where it's cheap in part because the company hasn't sold, but it should sell, and it's not controlled by any one shareholder who refuses to sell, then a fake takeover offer can actually mean that the stock should be worth more, even if the offer is completely fake. As long as people believe it long enough as long as arbitrageurs believe it long enough and strong enough to actually buy a bunch of the stock, and then who plan to vote in favor of merger. And, as long as, like, if someone comes up with a fake deal announcement, but it actually makes a lot of sense, then that's also evidence that maybe someone should go ahead and look at it and turn it into a real one. There was a case in the SPAC era where I think it was like Churchill Capital 4 or something, where it was taken public as just a SPAC. They had no particular target in mind. And then there was a rumor, I think Bloomberg shared this rumor that they were going to buy an EV company, and their stock went up in response to that rumor. And then they did end up buying that EV company, and in their filing detailing the background of the merger, they said they heard about this. This deal occurred to them because there was a rumor about it, and they saw how the stock price reacted to the rumor, and they were like, okay, this is actually what our investors want us to do, so we'll make it happen. So sometimes markets do just make stuff come true. In the case of Getty, that's not a valid reason to buy it, because Getty has controlling shareholders. It has the Getty family and the Koch family, the Koch the Koch Enterprises constellation of investing entities, and then a private equity firm. So it was not going to sell unless those groups wanted it to sell, and that didn't seem likely to happen. So in this case, doesn't apply, but the next time there's a fake merger announcement, keep it in mind.
Yeah. Speaking of announcement, there was the Google API documentation leak. Why don't you cover what you found so interesting there?
Yeah, sure. So this was someone accidentally put on a public GitHub repo a long document that detailed a bunch of API calls for Google search, which was it's really frustrating. So one of the things that came to mind was we use more and more AI tools, and AI models are like, we understand how to train them because people train them and they work, but we don't really. There's a lot of opacity, uncertainty on the inner workings of the model. Like, you can't label an individual weight and say that this corresponds to this real world concept or that other one. There has been some promising work in that direction, but we're not at the point where we can say, okay, if you change this number in the model weights, here's how the model's outputs will change. And so we have a bunch of numbers that are unlabeled. And then in the case of the API leak, we have a bunch of labels that are unnumbered. So Google has this list of factors that they are currently incorporating into rankings. We have no idea what the weightings are. We have no idea how they're used, or if one thing offsets another thing, if something is always in practice set to 0 in the code, so it doesn't actually matter, etc. But they're just, the list of factors that they use was really interesting. And what got a lot of attention was that Google has said many times that they don't treat clicks like click-throughs on the search page as a ranking signal. And there's just a lot of evidence from that documentation that they do indeed consider that as a ranking signal. And it makes perfect sense. Like both things make sense. It makes sense that you wouldn't tell people that, because then you're basically telling people, Google the term you want to rank for, click on your website, keep doing that, pay people in other places to do that, find the cheapest human clickers or human looking robot clickers you can, pay them all to click. It would mess with the search. It would mess with the search algorithm if Google disclosed that. But it's also true that if you do a search and Google and many other people do that search, and every time everyone is clicking on the second result instead of the first result, that the first result is wrong. It should not be the first result. Everyone's looking for this other thing. And so the algorithm should respond to that. So it's likely that before they explicitly looked at that, they would actually use that as a criterion for understanding whether or not a given search update that used other signals was actually a good one. But yeah, using it directly does get kind of tricky, but it turns out to be something that they do. And there were a bunch of other little details, like little flags for things like, yes, this is someone's small personal site, and that it was actually unclear exactly how that would affect the rankings. I would like to think that if you are searching for some long tail topic, that Google would rather show you a piece from one obsessed individual rather than some SEO spam that was written, partly by an algorithm, partly by a person who was not very interested in the topic. Hopefully that's what they do. There were other factors, like Google treats the sites that have a lot of video content differently from sites that don't. But it was also just what it really made me think was, like, one, in that list of ranking factors, there were just not a lot of major things where anyone would have said, I never would have thought of using that as a ranking factor. Like, a lot of it was just, here are the things you would think of if you were designing a search engine and trying to figure out what to rank for what query. So the fact that Google is so good, it seems to be less like there was, the really big innovation of PageRank. That was a really clever idea, that you can use the link graph as this way to implicitly rank not just like the importance and trustworthiness of a site, but also by using the text of links, you can figure out what that site is about. That was a very clever insight, and it's good that they had that, good that they ran with it. But like, a lot of what they seem to do is they do take the obvious signals that you would care about, and they're just very, very good at figuring out the right weighting for those signals and figuring out the right way to cleanly collect the data and make sure that it's not being manipulated too much by spam. And with any kind of software tool, like if you just build a piece of software, it's kind of a machine. Like, you put an input in, you get an output out. It's very mechanical. But once you're building software that people interact with and respond to, where they are determining what the inputs are and what the outputs are, and where the inputs are not just the search queries and the outputs are not just the results, but also one of the inputs is, what do people choose to put online, and how do they put things online? Like, are they putting relevant keywords into the content? Are they making it so that an algorithm could determine what the topic of this page is? Are they linking to other pages, etc.? That all becomes an input, and then the internet itself becomes the output of search algorithms and other algorithms that filter content. So once you know that, if you're Google, you have this social responsibility where the internet increasingly becomes whatever you tell people the internet should be from the perspective of someone who wants a lot of free traffic from Google search. And so if you tell them too much about the algorithm, they will all just compete to game the algorithm. If you give them a lot of tantalizing hints, but consistently remind them, as Google always does, that the way to rank well for the keywords you want to rank well for is have the best content about that topic, such that a completely unbiased observer ranking every website that has ever existed in the history of humanity would put your website at the top of the list. And, eventually that does kind of happen. It's probably not the case that, TripAdvisor always has the single best thing ever written about a specific hotel, or that bankrate.com has the single best piece of content ever written about mortgages. I've written about mortgages. I don't think the Bankrate stuff is extraordinarily great, but I think as a general heuristic, that's a pretty good rule. But what Google has, like, I would say there's like the kind of public facing or public spirited concern, which is, if you tell people all the ways that they can manipulate the search algorithm, that's what they'll spend their time doing, at the expense of writing content that searchers actually want to see. And then there is the more cynical and economically minded view, which is that if you have a product that people can find through search, there are two ways to turn money into search traffic. One is you spend money on manipulating the search engine in good ways and bad in order to rank well organically. And the other is you spend money on ads on Google. And so the more Google can reduce the returns and reduce the certainty of returns from organic search, the more people are just going to spend money on Google ads instead. So it's actually kind of nice that there is some sort of alignment of interest where Google does have an incentive to make SEO spam a harder business to execute in order to make their shareholders a lot of money, but also the side effect of that is that it makes the internet a better place. It's nice that the values are roughly aligned, but then there's always going to be a conflict. Like, the internet does not become a better place when Google adds one more ad slot above the organic results, but Google becomes a more lucrative company when that happens, and so that's eventually what they usually choose to do.
Okay, so you wrote about how Apple is planning to make Siri better at doing things within apps. What's happening there? Why is it interesting?
Yeah, so it was a vague kind of rumor, but it seemed credible and seemed interesting that the new revamped version of Siri will allow you to interact deeper within apps. So instead of opening an app, or like there are a handful of interactions, like you can tell Siri to play a song and it will sometimes guess the correct app, or you could tell it play it on Spotify and it'll usually get that right. But the more that you have a search product that goes very deep into the app and gets people the exact interaction they wanted, the more you have a product that can actually be monetized really well. So Google has been doing this for a really long time in search, where it used to be that search would give you a list of links, and then increasingly it was search would actually pull data from those links and either display the exact answer you were looking for. So if you look for person name plus age or person name plus net worth, they would just show you a number in both cases. And even when you click through on search results, they will increasingly take you to a highlighted chunk of text within a longer document that tells you the exact answer to the question you had. So they are moving from this idea of the web as a network of links to like the web as a way to organize information, and then search as a way to get to the exact piece of information you want. But with voice search and search through apps, there are just a lot of interactions that people do on the phone that monetize pretty well. And there are also a lot of cases where you have multiple companies that offer roughly the same end state, but it's through different apps. So if you ask Siri to play a song, that song exists on many different platforms. You could listen on YouTube, you could listen on Spotify, you could even listen on Apple Music. And once what you are asking for is the piece of content, and you're basically, Siri is kind of like piercing this aggregation layer and going right past it to the thing that was being aggregated that you actually wanted. Once they can do that and they can choose which route to go through when they're piercing that layer, then the people who own those broader platforms are in a position where it makes a lot of sense for them to bid for that. So it makes sense that if you have a music service, that there is some dollar value to that being the default service for Siri, and maybe it's not the default service for every user every time, but it's like Spotify could potentially find themselves in a position where Apple is telling them that for users who are paying for Spotify and not paying for any other music service, here's how much it costs for, hey Siri, play some Taylor Swift, to go directly to Spotify. And then for, that activated Siri. We live in a time of wonders. There's probably another price for, hey, if these people are paying for Spotify and they're also paying for Apple Music, here's how much it costs for Spotify to get the play. And then you could even take it further and make it more aggressive. And I think, like a lot of other ad-supported services, like, it starts out as, here's a way to pay in order to not inconvenience your existing customers. And then here's also a way to pay to attract people who are looking for something generic. They're not tying it to a particular provider, particular brand name, but they do want that end result, and you can pay to be the one to provide that end result. And then eventually it tends, like at the point of peak monetization, it tends to be like, if you are getting some kind of traffic, some kind of usage, some kind of value out of having your app accessible through Siri, you are paying Apple a significant chunk of that value. And the more of these interactions that get monetized, the more pricing power the company has. So this is very analogous to Amazon doing ads for products, where it started out as just a way to get slightly more attention for a product that wasn't ranking well, and then the number of ad slots kept going up, and bidding got more competitive, and it got to the point where you had to pay. You have these sort of fixed shares of revenue that you pay to Amazon for just expediting the transaction and shipping your stuff, and then you have this variable cost where you're bidding for the click when someone is searching for a generic product and you sell one variant on that product. And of course, you're going to keep raising that bid until it reaches the point where the contribution margin is wiped out by the ad cost. So Amazon, they basically have a dial that says like how much of this margin goes to the merchants and how much of this margin goes to Amazon. And every time they need to show a little more growth, they can spin that dial a couple more ticks. And they have other levers they can pull. If they find a product where someone doesn't have to spend a lot on ads because there isn't a direct competitor, then they have a strong incentive to create an Amazon Basics version of that product, or otherwise encourage other people to sell competing products on the site. So yeah, it does create a situation where there's just a lot of ad revenue to capture. There's a lot of margin that was going to the end provider of the product and is now going to whoever decides which product the customer ends up using.
Cool. We're cutting this one short a little bit because I have to run to something. But Bern, this has always been a pleasure, and maybe because we're cutting it short, I'll leave the listeners with a treat that we're going to have Patrick McKenzie on as a guest at some point soon, and maybe some other guests in the future. And we're always taking recommendations. If people want to hear other guests or other topics, just email us. We'll have it in the email in the show notes. But Bern, as always, this has been great, and to be continued. Until next week.
Great. All right. See ya.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Bern's excellent newsletter, The Diff, if you haven't already. Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at ericaturpentine.co. That's ERIK at turpentine.co, and let's partner together.